Good morning. My name is Rob Newman and I am one of the partners at Carter Collins and Meyer. We're a firm of accountants in Rochdale, North Manchester, and we work with clients across Greater Manchester. And we specialise in working with smaller owner-managed businesses. And one of the most common things that I see in smaller managed businesses is failure. Now, failure is not something that us people want to address, but it's better to know in advance how you walk out of the room than rather just how you walk into it. And if you don't have that clear vision of how you walk out of the room, failure can be made worse in the small business environment. Because of this, I talk a lot about insolvency work and insolvency pre and post. Now, I'm not an insolvency practitioner, and for proper, pure insolvency advice, you should speak to somebody who's regulated. But as somebody who works closely with owner-managed businesses, I know the signs of it and what needs to be done to protect you. And protect you is one of the very key things that I will have, because one of the moves in the insolvency world that I have seen over the last 5 years since COVID is an increasing use of misfeasance. Insolvency practitioners for a long time went after people on the basis of wrongful trading, and there was lots and lots of cases around wrongful trading, and it became quite hard for them to prove that. Whereas misfeasance became a much softer thing for them to be able to prove, and in large respect, it is still being proven as to what exactly it is. But misfeasance is any action or inaction that has allowed the business's position to get worse. And by getting worse, the people owed money by the business, the creditors, their position has got worse. And if an insolvency practitioner can prove this, they can then come after you as an individual. They can make it a personal liability. They can lift the veil of incorporation and say, you must make up the difference. And I'm seeing that more and more and more. Increasing numbers of misfeasance cases being brought against small owner-managed businesses. And when it does, it's hugely expensive and hugely disrupting, because you will need solicitors, you will need forensic accountants, which is something I do quite a lot of. You will need lots of support. It's not just another set of accounts or another form. Insolvency practitioners have a lot of power. They are officers of the court, and they can dig and dig and dig, and often are seeking some form of settlement to make a distribution to creditors. Now, that is their job. That is what they are there for. They are there not to protect you as the business owner, but to get the maximum recovery they possibly can for the creditors of the business. So today's video, after a long introduction, is about the signs of businesses going into insolvency, the actions that can happen, and what you need to look out for and watch from your own behaviour in the steps that you take to ensure that you don't fall under a misfeasance claim. Now, one of the most common signs that you will ever see is cash flow strain. Cash flow strain is being unable to pay a bill when it falls due. Now, nobody likes paying bills, including me. Heck, I recently had to pay my own tax bill, and it was horrible to have to do. But if you genuinely can't pay it, even if you are seeing on accounts that you are profitable, you are insolvent. You have a problem. And saying that, well, when Fred pays me, I can then pay it out, is a classic sign of insolvency. And it usually comes in profitable businesses when they are overtrading. Overtrading is running faster than your skills and base actually allow you to do. In a physical sense, you will end up pulling a hamstring. In a business sense, you will run out of money. And when you run out of money in this circumstance, you go bust. Now, the next stage on those is a more accountancy model, a balance sheet test. Does what you are owed come to more than you owe out? Are you solvent? Is there a positive acid test, is what accountants and insolvency practitioners will call this. And The cash flow implications is quite easy to see, but the acid test of your balance sheet of taking one number and dividing it by another are often not seen, but usually fall together. So an insolvency practitioner building a case will take both of those and say, you're not paying enough attention to your own business. You're not seeing enough of what's going on, and because of it, your actions are negligent, and your negligence is misfeasance. So watching for when you are saying that I am struggling to pay that bill, or I am struggling to actually see what's going on, is one of the clearest signs. Living paycheck to paycheck, which many small businesses do, is a real risk, because suddenly one of your customers goes bust, and one of your customers goes bust, and now you can't pay your bill. You are insolvent. So what should you do? Well, I'm going to say the obvious thing. Come and talk to me. Come and talk to an accountant. Come and talk to somebody in this world. The earlier you take advice, the more evidence you can put together that you tried. And that's one of the key things of protecting you as an individual. You have to be able to show that you tried to do everything that you can to protect creditors. So if you take advice and document that advice, even if there's a small cost to it, and to be honest, I don't charge for this type of thing. I'll happily have that conversation. But if you document it and write it down and have it there, have an email from somebody like me and keep hold of it. I had this concern, I took that advice. You are starting to build a protection. If it all works itself out, fantastic. You can forget that that happened. But if then it got worse, you need more advice. And yes, there will be a cost, and it's a cost sometimes at the time when you least need it, when you least need to pay for that report, for that thing. But building up a pack of documentation to show that you did everything you could is how you will protect yourself from a misfeasance claim, and how that you will show that you were aware of the tests that are applied for insolvency. Now, one of the next key stages, if you're really struggling, is to work with somebody, and there's lots of great examples online that you can do, to produce a cash flow model. So even if you have an online model that you found somewhere, run it past somebody, run it past an insolvency practitioner, run it past your accountant, run it past somebody that is shown to have some form of qualification. Because if you do and you have a response back for them, again, you realize there was a problem. You modeled it, you created a cash flow of where things will happen. And if that cash flow looks positive and shows that you can trade your way out of this, you've protected yourself even if you fail. If you do fail, you have that pack of paper and documentation that again shows that you did every step that you can take. Now, all of this is showing that you are a going concern, that your business is a going concern, because everything changes when you realize it's not a going concern. When the documentation shows that it can't continue, you have to change how you run a business. You have to change it to ensure that you are looking after the creditors of the business, the people you owe money to. And in so doing, many things change. For example, that stock that you bought and had on your shelf now has to be valued as if it was going to be sold on eBay tomorrow, instantly, to get rid of, which cuts its value, which itself will make you more insolvent. The recovery of your people who owe you money, your debtors, again has to be listed as if you are forcing them to pay you really quickly. So again, it will make you seem like you are more insolvent. So that going concern test is really crucial. And it's again how insolvency practitioners catch out, unfair term, but catch out lots of small business owners, because the small business owner doesn't have the documentation in place to show that they realized they were no longer a going concern. And by not being able to show that they were no longer a going concern, the insolvency practitioner can come up with a misfeasance claim. Now, the approach that you should take for these and the things that you should do is be aware, know that this is happening, know what's going on in your business, feel that cash flow, talk to other people, and access some training. Now, this is training. This is professional development. But things like the Federation of Small Business, the Chambers of Commerce, run fantastic events for free or almost free that allow you to have some awareness of this type of situation and know that this is going on. It can save you a lot of pain down the line. And again, one of my key jobs is to help you save that pain. I can be there for the good times, and they're easy. When things are going great, it's easy to start saying, let's make pension contributions and buy lots of assets, but I'm also there for when things go bad. But no, there will be a cost. And I would say to you, budget that cost into what is going to happen. Know that it's cheaper to pay for the advice at the beginning than it will be to have to face a court or an insolvency practitioner if it fails. So if you are going through a really hard time at the moment, if 2026 is not looking promising, if your order book has collapsed, you need to go and take some advice, you need to go and talk, and you need to see if your business still is a going concern to ensure that you don't fall under a misfeasance claim. Now, thank you for listening. My name is Rob Newman. I'm from Carter Collins & Meyer, a firm of accountants who works primarily with owner-managed businesses across Greater Manchester, Lancashire and Cheshire.